if you're using trend lines but still losing trades, the problem isn't your strategy, it's your approach. Most traders use trend lines blindly, and that's exactly why they get trapped in fake breakouts. In today's video, we'll learn how to draw trend lines, fake breakout versus real breakout, high probability entries, trendline breakout strategy, real chart examples. What is a trend line? A trend line is simply a diagonal support or resistance level. We draw it by connecting swing highs in a downtrend, connecting swing lows in an uptrend. The market doesn't move in a straight line. It moves in waves. Impulse, pullback, impulse. And this structure helps us identify and draw trend lines properly. How to draw trend lines correctly. This is where most traders make mistakes. You need at least 2 strong touch points. Use clear and obvious swing highs or lows. Never force a trend line. Let the structure guide you. Pro tip: think of trend lines as zones, not exact lines. You can use wicks or candle bodies, but don't switch between them just to fit your bias. Consistency is key. Why trend lines matter? Trend lines serve 2 major purposes. 1. Dynamic support and resistance. In an uptrend equals support. In a downtrend equals resistance. 2. Trend reversal signals. When a trend line breaks, it can signal either a reversal or fake breakout. Fake breakout versus real breakout. This is the most important part. Fake breakout. Small candles. Weak momentum. Price breaks slightly and reverses. Traders get trapped. What to do? Don't rush your entry. Wait for confirmation. Real breakout. Strong large momentum candles. Clean breakout. Follow through movement. Best confirmation. Break of structure. Formation of higher highs or lower lows. Trend continuation strategy. In strong trends, the best trades come from continuations. Setup. Identify the trend. Draw your trend line. Wait for price to return to the trend line. Enter when you see a bullish or bearish engulfing candle. Strong rejection from the trend line. Confluence equals high probability trades. Never trade based on trend lines alone. 4 high probability setups combine support and resistance, liquidity levels, fair value gaps, price action. When multiple factors align, it's called a high confluence zone. When the market reaches this zone, we will look for a buy entry. The stop loss will be placed slightly below the buy zone, giving us a strong risk-to-reward ratio. One of the most common questions traders ask is, should you draw your trend line using the wicks, the candle bodies, or both? Here's the answer. Always draw your trend line where you get the maximum number of touches. Let's understand this with an example. In a clear downtrend, when you align your trend line with the most significant swing points, you'll notice that sometimes it touches the wicks, while at other times it aligns with the candle bodies. In some cases, it may perfectly connect the wick highs, and in others, it may slightly cut through a wick to connect with a candle body. The key takeaway is simple. Your trend line should capture as many valid touch points as possible while staying consistent with the overall structure. Trend lines are tools, not strict rules. Use them to guide your analysis, not as fixed entry or exit signals. Now that you understand how to draw trend lines correctly, let's take it a step further and see how to combine them with price action to find high probability trade setups. Before we continue, if you're getting value from this video, make sure to hit the like button and leave a comment below. Your feedback helps improve future content. We use trend lines in 2 main ways. First, trend following trades, where we trade in the direction of the current trend. Second, reversal trades, where we look for potential trend changes. Let's start with trend following. One of the most effective approaches is to look for areas where a trend line aligns with key support or resistance levels. These are known as high confluence zones, areas where multiple factors come together, increasing the probability of a strong reaction. Here's how it works step by step. First, identify the overall trend. If price is forming lower highs and lower lows, the market is in a downtrend, so we look for short opportunities. If price is forming higher highs and higher lows, it's an uptrend and we focus on long positions. In this example, the market is in a downtrend, so we only look for short trades to stay aligned with the overall direction. Next, draw the trend line by connecting at least 2 swing highs and extend it forward to act as a dynamic resistance level. Then look to the left of the chart and identify any previous support that has been broken. This level often turns into resistance when price returns to it. Now, where the trend line and this resistance level meet, that becomes your high confluence zone. But here's the important part. We do not enter the trade blindly. Even if price reaches this zone, it can still break through and reverse. That's why confirmation is essential. As price approaches the zone, watch how it reacts. A bearish rejection, such as strong red candles rejecting the level, can indicate selling pressure, but this alone is not enough to enter a trade. The trend line breakout strategy. This focuses on identifying potential trend reversals. But here's the mistake most traders make. They assume every breakout means a reversal. That's not true. Many breakouts are fake, designed to trap traders. To avoid this, we look for additional confirmation before entering. For example, in an uptrend, if price fails to make a new high and starts forming lower highs, it signals weakness. A break below the trend line confirms potential reversal. For even stronger confirmation, look for patterns like double tops or double bottoms before the breakout. Finally, always use multiple time frame analysis. Aligning your trade with a higher time frame trend significantly increases your probability of success. Whether you're scalping, day trading, or swing trading, always look at the bigger picture before entering. Now you have a complete understanding of how to use trend lines effectively with confirmation and structure. Professional traders always check higher time frames, then enter on lower time frames. Example: trading on 5 minutes, confirm on 1H. Trading on 1H, confirm on daily. When both align, your trade probability increases significantly. Final strategy summary. Remember these rules. Trade with the trend. Draw trend lines correctly. Avoid fake breakouts. Use confluence. Never enter without confirmation. If you found this video helpful, make sure to hit the like button. Comment below and tell me, what topic should I cover next? And if you're serious about trading, subscribe to the channel, because here you'll learn real trading.